to Iron Financial, the show where we forge stronger portfolios by cutting through the market noise. Today, we're putting Papa John's under the microscope. Their latest earnings report just dropped, and frankly, on the surface, it looks like a house of cards. But when you dig into the numbers, you find a story that's a lot more complex, a real puzzle for investors to solve.
All right, let's get right to the core of it, the central paradox. How in the world does a company's sales number miss Wall Street estimates and by a wide margin, while at the same time their profit per share actually beats expectations? It doesn't seem to add up. You sell less stuff, you should make less money, right? Well, that's the disconnect we're here to break down. This isn't just an accounting trick. It's a sign of a massive strategic shift happening inside the company, and we need to figure out if it's a solid foundation for the future or just papering over some serious cracks. So here's our game plan. We're going to start with that baffling headline and see how the market reacted. Then we'll drill down into the North American business, where things look pretty grim. We'll contrast that with their international operations, which, believe it or not, are firing on all cylinders. After that, we'll lay out management's explicit recipe for recovery, their blueprint for how they plan to fix this. And finally, we'll talk about the very real risks that could derail this whole turnaround story. Let's get to work.
Okay, first, let's dissect this headline. Because when a company reports two numbers pointing in completely opposite directions, you have to understand what Wall Street decides to pay attention to. That initial reaction tells you everything about market sentiment.
Here are the two numbers at war with each other. On the left, you've got revenue, the top-line sales number. It came in just under $500 million. That was an $18 million miss. That's not a rounding error. That is a significant shortfall. It means people are buying less pizza. But then, look at the right, earnings per share, or EPS, which is the bottom line profit. That came in at 34 cents a share, a full 2 cents higher than analysts predicted. So you have a weak top line, but a surprisingly strong bottom line. This is the kind of report that gives analysts headaches. It's a signal of weakness and a signal of strength all at the same time.
So, what was the market's verdict? Did they cheer the profit beat, or did they punish the sales miss? Well, the numbers don't lie. The stock immediately got hammered, dropping nearly 4% in pre-market trading. And that tells you something absolutely critical. Investors are far more concerned about the cracks in the growth story than they are impressed by a small, engineered profit beat. They looked at this report and saw a shrinking business, and no amount of financial wizardry on the bottom line could hide that fact. Growth is the fuel, and the market saw the tank running low. So where is this weakness coming from? Why is the top line shrinking? We have to look no further than Papa John's own backyard, the North American market. This is their core, their foundation, and right now, that foundation has some serious cracks. The key metric for any retailer or restaurant chain is comparable sales, or comp sales. It tells you how sales are doing at stores that have been open for at least a year. It's the purest measure of organic health. And for Papa John's in North America, it is a disaster. Look at these numbers. Company-owned stores are down almost 6%. Franchise stores, down over 5%. The total for the entire continent is a drop of 5.4%. This isn't a slowdown. This is a significant contraction. It shows that across their entire domestic system, they are losing ground. Customers are either choosing competitors or just not ordering pizza as often.
So what's management's explanation for this? The CEO, Trod Penegor, pointed to two things. First, a weak consumer backdrop, which is corporate speak for our customers are feeling broke. Second, an elevated promotional environment, which means his competitors are in a knife fight over discounts, and it's a race to the bottom on price. So you've got customers with less money to spend, and every competitor screaming about their 2-for-1 deals. That is a brutal environment to operate in. The question for investors, though, is whether this is just a temporary storm or a fundamental weakening of the brand's position in its most important market.
But here's where the story takes a fascinating turn. While the North American business is getting pummeled, there's another part of the company that's not just surviving, but absolutely thriving. We have to pivot overseas to find the international bright spot. It's truly like looking at two completely different companies under one roof. Now get ready for some whiplash. Remember that negative 5.4% comp number in North America? Well, internationally, their comparable sales were up almost 6%, a positive 5.9%. That is a massive swing. We're talking about an 11-point spread between their domestic and international performance. This isn't just a silver lining. The international business is the only thing preventing the company's overall sales from falling off a cliff. It's doing all of the heavy lifting right now, propping up the entire structure. And don't think this is just a one-time lucky quarter.
This marks the 5th straight quarter of positive comps for the international segment. That's over a year of sustained, solid growth. This isn't a fluke, it's a trend. It shows that whatever formula they're using overseas, be it their marketing, their menu, or their expansion strategy, it is working. They have built real momentum, and it proves the brand has significant power outside of its saturated home market. So how are they getting it done? They're building aggressively. In the fourth quarter alone, they cut the ribbon on 101 new international locations. Think about that. That's more than one new store opening every single day. This is a clear, deliberate strategy. Management sees the writing on the wall. The North American market is a low-growth, high-competition trench war. The real opportunity, the blue sky, is overseas. They are pouring capital and concrete into global expansion because that's where they see the future of the company. Okay, let's circle back and finally solve the second part of our puzzle. We know why sales were weak, North America. But we still need to understand how profits were strong. This is the recipe for recovery, the nuts and bolts of how Papa John's is trying to re-engineer its financial structure to be leaner and more resilient. Their plan is a three-pronged assault on costs and inefficiency. First is the refranchising program. They're selling off dozens of their company-owned stores to franchisees. This is a brilliant financial move. It takes volatile day-to-day operating costs off their books and replaces them with a steady, high-margin stream of royalty payments. Second, they're taking a chainsaw to their budget. They are targeting massive savings at both the corporate level and in their supply chain. And third, they are laser-focused on efficiency, using technology and process improvements to make each individual restaurant a more profitable operation. This isn't about selling more pizzas tomorrow. It's about building a fundamentally stronger, more profitable business model for the long haul. The entire strategy really boils down to this one concept: four-wall profitability. It's a simple but powerful idea. They are telling their franchisees and store managers to forget about corporate overhead for a minute. The only thing that matters is this: within the four walls of your single restaurant, are you making money? Do your sales cover the cost of your ingredients, your labor, and your rent? By focusing intensely on this metric, they aim to ensure that every single location in their system is a healthy, self-sustaining financial unit. If every brick is strong, the whole wall will be strong.
And they aren't just talking about it. They've put a hard number on the goal. They are aiming to recapture 200 basis points of margin. That's finance speak for 2 full percentage points. That might not sound like a huge number, but on nearly $2 billion of annual system-wide sales, a 2% margin improvement is an enormous amount of money flowing straight to the bottom line. This is the tangible financial target that all of their cost-cutting and efficiency efforts are designed to hit. It's an ambitious blueprint for rebuilding their profitability from the ground up.
Now, we've laid out the plan. It sounds good on paper, but no plan survives contact with reality. At Iron Financial, we always stress test the bull case, so we have to be clear-eyed about the very serious risks and challenges that are still on the menu for Papa John's. This turnaround is far from a sure thing. And the list of headwinds is long. The consumer caution they're already seeing, that might get worse, not better. The intense competition, that's not going away. Pizza is one of the most cutthroat segments in all of fast food. Then you have external threats like supply chain shocks that could spike the cost of cheese or flour. And internally, there's massive execution risk. Can they actually achieve those cost savings? Will their new technology work? And all of this is set against a backdrop of general economic uncertainty. There are a lot of variables here that are completely outside of management's control. And to fully grasp the scale of the mountain they have to climb, just look at this 5-year chart. The red line is the NASDAQ benchmark index. The green line is Papa John's stock. It's not just a little bit of underperformance. They have been absolutely left in the dust by the broader market. This tells us their current problems are not a new phenomenon. They are symptoms of a deeper, long-term struggle to generate value for shareholders. They are trying to reverse years of structural weakness, and that is some of the heaviest lifting a management team can possibly undertake. So that brings us to the final, critical question for any investor looking at this company. You have a domestic business, the core of the company, that is shrinking. At the same time, you have an international business that is growing rapidly. And management's big plan is to offset the domestic weakness with an intense focus on cost-cutting and efficiency. So, can this recipe actually work? Can you truly cut your way to prosperity while your main market is in decline? Or is this just a strategy to manage a slow-motion decline gracefully? For Papa John's, the clock is ticking, and the market is watching to see if this new foundation will hold. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.